Welcome in our guest talking about some of the worries around fiscal slippage and really whether or not those OMOs have been enough to rein in yields, the likely impact as well on the bond market. We've got Ashutosh Khajuria, the ED at Fedbank, and Bhaskar Panda, Treasury Advisory at HDFC Bank, joining us this morning. Gentlemen, thanks for being with us. Let me just start off with you, Bhaskar. How are you assessing, the overall scenario currently? Do you see the RBI continuing to intervene in 20 in order to really pump prime the economy? We've already started to see that, of course, towards the end of the year. What are you anticipating as we move forward?
Growth is a concern that every one of us know. So to kind of bring in the growth, whatever is needed, I think will be done by both government and the RBI. Having said that, if we look back and see what has happened in 2019. So what we have seen is that there has been a yo-yo kind of movement in the bond markets, especially the 10-year bond yields have gone up, come down, along with the news that has come, and the latest one being the what people call Operation Twist, and that has brought down the bond yields, 10-year, especially the 10-year bond yield from almost like 50 basis points in a kind of single day. So whether this trend is going to continue in 2020, very unlikely. But whether RBI will keep on doing Operation Twist, probably yes. How many times, it is very difficult to say. But probably they will continue with some more, Operation Twist kind of going in the coming months, and probably they will stop somewhere, maybe after 2 or 3 times of maybe 30,000-40,000 crores. After that, they might stop. That's my expectation as of now.
While Operation Twist is a replica of what the US Treasury did, do you think the initial objective, in a sense, has not been achieved? Because what you're trying to do is that you're trying to bring the interest rates down. But in a country where inflation moves between 3 to 5% or sometimes between 3 to 7%, do you think something like this on a longer term basis is not going to work?
Longer term, I don't think it is going to work, because I don't think they can keep on doing this for a very long time. I think this is a very temporary measure, and I think they have achieved their objective by at least bringing down the yield from, say 10-year yield was going at 680 before this was announced, and now that jumped to 640 immediately. So now it is around, say, 650, 655. And with inflation going up, the expectation for yield was to go higher, in fact. And if we say, or if we presume that, government's borrowing is going to be higher than expected, so basically you would have moved the yield higher. So now what they have achieved is that at least the yield has come down to a desired level that they might be wanting to see. So I think from their point of view, it's, it has already yielded results for them.
So go across to Ashutosh as well, understand from him how he's been what he's been making of the latest, OMOs, how it's impacting debt investors, and also going forward, Ashutosh, there have been reports that the government may be redrawing the fiscal roadmap. What are you making of these reports, and what do you foresee happening?
I think they will have to rework the fiscal math. Of course, there is absolutely no doubt about it, because assuming that, I'm not sure, but assuming that this year we end up at about 3.8% of GDP as fiscal deficit, and if you want to bring it down by 50 basis points, I think we'll be back to square one. Whatever so-called quantitative easing or accommodation is being provided would be annulled and all. That's one point. And second is, of course, I have never seen, in at least nearly 20 years in bond markets, but I have never seen in accommodative stance your repo rate having, a spread of something like 170 basis points or so. Because when repo rate was at 5.15, we saw 10-year touching 6.84. And that too in accommodative stance. It's not in something, where you are tightening or you expect, all sorts of, rate increases and all that. So I think that simply shows that going by the expectation theory, expectation theory, the market has already prepared itself to be to have a larger fiscal deficit, much larger borrowing program. And I think that situation is not likely to change in FY 2021 because nothing is materially changing except probably if certain things, certain steps that have been taken this year for disinvestment and all, and they're not being able to, conclude those during the fiscal year and they are carried forward to next one, we may see more of, I think the CPSEs, there being, disinvestment happening, probably a couple of privatizations as well. So I think that may be good because for improving efficiency, I don't say private sector is always more efficient than public sector, not necessarily. You have problems in private sector as well, and we have seen the type of fall in corporate governance and all that. I'll not digress into that, but I think market is certainly expecting a much bigger fiscal deficit in at least absolute terms, and I don't see denominator also growing very fast because GDP also is not likely to immediately come to in nominal terms to 11-12%. Nominal is more important than the real one for fiscal math and all, and for revenue generation and various other things.
All right. Fair enough. Ashutosh, so understood all the factors and how you're seeing this, but what's the impact on yields going forward? Also, given that we're not seeing that transmission on ground, and that's a big problem we continue to grapple with, do you see any easing on that front going forward? Is that going to continue to bother the markets?
One thing is quite clear now that RBI, though it was earlier, legislatively, if you see, they are supposed to take care of the price stability first, and that's the first and foremost thing for them to happen. But even when, and they were looking at CPI, the headline number, not the core and all, going by their, earlier descriptions and all. And now core is in excess of, 550 and all. And still, there is a talk of pushing the growth. That means it has been now well recognized that for some time, at least in the near future, the focus would be more on pushing the growth up, creating employment, and therefore bringing purchasing power in the hands of the consumers, and that can be done through fiscal measures as well. So budget also would be very crucial. Already, corporate taxation cut has been a very major step, I would say, in this direction. So let's see. I think nothing happens with a magical wand. It takes time. Whatever reforms you introduce or whatever changes or measures you take, they take their own time. They have their own gestation period or so. So looking into that, I think growth to 6+ and all numbers may take another 3 to 4 quarters from now. So probably we may see that happening in second half of the next financial year decisively. There may be some, because base also would be quite, low at that time. On that base, these numbers are possible to deliver and all.
Joining us this morning, Mr. Panda and Ashutosh, and taking us through that discussion. We're going to leave it there. We need to take a quick break. We'll be back on the other side.